It is no secret at this point that California is suffering an insurance crisis. Major wildfires have caused private insurance companies to deny coverage or just leave the state altogether. That leaves hundreds of thousands of homeowners with the insurer of last resort. It's known as the California Fair Plan. And while it's never been a bargain and it's not been cheap, it may be about to get a lot more expensive. John Ramos explains why.
The entire city of Clayton shares a common zip code, 94517, and hundreds of homeowners here share something else. They've all been kicked out of their insurance companies and sent to the California Fair Plan, which means they have one more thing in common. Their insurance rates may be going up big time. Clayton doesn't seem very dangerous, but the insurance companies sure think it is. Perhaps because of its proximity to Mount Diablo, 215 homeowners have been kicked to the Fair Plan, which covers only fire loss and can cost thousands of dollars more than private insurance. The Fair Plan was supposed to be just for those at highest risk, but the mega fires have given its customers a lot of company.
So today, with the number of policies we're writing, we are one of the largest writers of residential property insurance in the state of California. For us specifically, within the sustainable insurance strategy, the California Fair Plan needs to have adequate rates.
They have submitted what those increased rates should be at the California Department of Insurance, an average hike of 35.8% for about 4 out of 5 policyholders. And for Clayton, it would be much higher. Fair customers there will pay an average increase of more than 69%. Joe DeJani is a realtor who has sold more than 500 homes in Clayton and feels for those who end up in the Fair Plan.
Well, the Fair Plan was so expensive to go to, a few years back. Now, all of a sudden, if we're looking maybe a 69% increase, absolutely, that's a concern. Yeah. And it's also going to be a concern for purchase. So buyers may choose to purchase other locations.
Carmen Balber is an executive director of Consumer Watchdog, a ratepayer advocacy group that frequently does battle with the Department of Insurance.
A double-digit increase of this size would be a devastating blow for consumers who are already paying too much for too little coverage under the Fair Plan, particularly in those places that are going to see the higher end of those average rate increases.
But she says the Fair Plan may sound like a government-operated agency, but that's not really the case. Its inner workings were recently studied by the Climate and Community Institute.
And in the case of California, we found that 100% of the representatives that have voting power in the governing committee of California's Fair Plan were industry executives or company representatives, which just shows that these fair plans are not fulfilling their mandate or reflecting the fact that they're public policy, but instead are run for and by private insurers, basically.
Usually the story is Fair Plan, the state insurer of last resort, and people hear state insurer, and that's all you get. And so, no, I don't think most people know that the Fair Plan is run by the very people who screwed them over to begin with.
The insurance commissioner will decide how much of an increase the Fair Plan will actually get. A few years ago, they asked for 48% and got 15%. So the rate hikes submitted are not a done deal. But those who are currently paying for the Fair Plan may be wondering why the state's insurer of last resort would be demanding a rate of every last dollar.
Ironically, some Bay Area zip codes may actually see the rates lowered under this proposal. It's part of the state's new policy that allows insurers to base their prices on actual wildfire risk.